Don't make the same mistake as everyone else. I looked at the technical analysis and I looked at the data, and I am going to present that to you today. When we look at the markets, when we look at what's happening with the economy, there's a clear disconnect. I'm going to show you what everyone seems to be ignoring, and yet it's right in front of our face. Let's begin right here by taking a look at our friends at the Federal Reserve. Of course, this institution is incredibly important, but look at all the other countries, the actions they are taking, and we start to dig through all the pieces. The market came down on Wednesday's trading session as a result of something that happened. I'll break that down right here. If you find it valuable, simply hit that thumbs up to support the channel. Let me show you right here and now. You can see Fed's Collins says policymakers can proceed cautiously on future rate hikes, essentially saying what we've heard before from Jerome Powell and others, that they are probably near the end, but they do not want a repeat of the 1970s, and as a result are willing to take this even further. Markets didn't like that, and they didn't like something else as well. I'll show you that also. We are going to look at several different factors though, and I want to show you, while yes, this is key, this is important, this is the clear driver, there's something people are forgetting to acknowledge. The plain and simple fact of all of this is that the biggest concern for investors right now is higher interest rates. They want to know that not only will they stop increasing, but that they'll cut. The Bank of Canada, they held it, and they're hoping that the Federal Reserve will do the same. Commercial real estate is the real issue, and that is what I think needs to be acknowledged. I'll break that down for you. And guess where delinquencies are rising? Can you take a guess? This could be in different types of debt. Maybe that's car loans, maybe that's credit cards, maybe that's student loans, maybe that's mortgages. Where is the big concern today? We'll look at that as well, but I want you to guess if you can. We'll see who gets that correct. Let me show you what's going on as well. The markets were a sea of red, and I thought it was important to acknowledge the fact that this has come at a time in which there's been a lot of bullishness. But I looked at the charts, if you could see it back here, and on the daily chart we moved into what's called bearish control. But zooming out, there's still a lot of bullishness out there, and some of that steam has been worn off, which of course markets love. They love an opportunity to go in and buy the non-existent dip. So that might be complicated to some, but let me tell you, I'm going to explain it all. Okay. Overconfident markets paradoxically transform brilliant future business prospects into even more brilliant current stock price levels. Nvidia is today's exemplar of that genre, a great company priced beyond perfection. All right. And essentially saying that, hey, the market cap $1.2 trillion, this is a safe play, but don't make it appear that way, because they're really running on fumes right now when we talk about the valuation that the market has assigned to this one company. And that, it's easy to pick on Nvidia simply because it's multiplied in price in such a short period of time, but we have to know where the fundamentals are, and then we got to understand, what do we want to be trading and what do we want to be investing in over the long term. These are two very different things. Don't treat them the same. Roku stock jumps, check this out, after company says it will lay off 10% of its workforce. If there's one thing that the stock market loves, it's firing people, increasing productivity, as they like to call it. So pay attention to what companies are doing and why. You might get a big boost initially, but is that something that you want to see? A company that's continuously laying off people? Fed set to double its economic growth forecast after strong US data. This is important. This is what I wanted to show you here. It's that if they are going to say everything is fine, everything is wonderful, well, then that means, according to the data, that everything is going to be okay if we continue to raise interest rates or keep them at these levels. And that is something the markets don't like. All right. So in their beige book, they talked about a few things, in terms of slowdown, in terms of recession or whatever. But this happened to be what they say right here, the Fed now data. I mean, there are different ones, and basically they try to, this is the Atlanta Fed growth tracker. They try to assess where things will be in a short period of time. They're never accurate, but the point is it shows us over 5% growth. How is the US going to get to 5% growth and beyond, which would be even better than the surge that was experienced after what went on in 2020? So I'm dumbfounded. I don't know if you can read that crystal ball. Please let me know. But anyway, if things are strong, that is a better case to keep interest rates high. You see what I'm saying? Okay. Now we need to talk about the obvious: commercial real estate. Commercial real estate. And this is important, okay? Very important for various reasons. I just want to touch on a few things quickly. Higher stocks and job growth make increases more likely. So when we're talking about this, before we look at this big issue of commercial real estate, understand that if the markets are doing well, if employment is okay, all these things one after another, then it's an excuse for the Federal Reserve to say, you know what, we're going to leave interest rates high. That would be devastating. Potential impact to stocks, but high risk environment is where we're at. So any little dip, they're willing to buy in. That's what I'm saying about Nvidia, just one particular stock. But you see that. Stocks come down by 2%. Oh my goodness, it's a discount. Everything's on sale. Get in and buy. This is a high risk environment that we are in right now. There is no fear. I don't care about fear and greed index. There is no fear. There's some important stuff here. And it's important that we dig into this as deep as we can. I need to do a whole video about it. But for the time being, let's cover something that I think is essential. Real estate doom loop threatens America's banks. Regional exposure to commercial real estate is more substantial than it appears. Now we have a problem. I'm going to tell you what you need to do at the end of this episode, so please stick with me. And remember, if you're finding it valuable, just hit that thumbs up button right now. It'll help me out a lot, so I do appreciate that. Now, you got to understand this. I've been talking about it for a long while. And I've been highlighting the fact that commercial real estate, particularly when we had SVB and the others start to fall down, well, this was a big concern. And now we have more and more data showing that this bank crisis ain't over yet. Here we go. Bank OZK had 2 branches in rural Arkansas when chief executive officer bought in 1979. This Little Rock lender today has billions of dollars in commercial real estate loans, including properties in Miami and Manhattan, where it helped fund construction of a 1,000-foot tall office and luxury residential tower in Fifth Avenue. Fantastic, right? Okay. Regional banks across the country followed a similar playbook, gorging on commercial real estate loans and related investments in big cities over the past decades, with commercial real estate now in a meltdown. They're saying it's in a meltdown. This is the Wall Street Journal saying that. I've said that before. This is the Wall Street Journal. These trillions of dollars in loans and investments are a looming threat for the banking industry and potentially the broader economy. Banks' exposure is even bigger than commonly reported. The banks are in danger of setting off a doom loop scenario where losses in the loans trigger banks to cut lending, which leads to further drops in property prices and yet more losses. Bank OZK hasn't pulled back from lending, but has started to see some signs of market trouble. And of course, we start to see the commercial mortgage-backed securities that all of this stuff is connected to become an issue. Because just like the asset-backed securities that were there back during 2008 timeframe that we found out about, this is really no different. It's just on the commercial real estate side. This is a very big concern that is just ignored. Well, you know what? Hey, it's not a problem. Bank issues done. It's all good. Is it really? Really? We're going to ignore something this big? The markets are looking at Nvidia. The markets are looking at these little things that are quite frankly insignificant in comparison to this. And so we've got to pay close attention. I'm going to bring you all the latest and greatest details about this. In fact, a whole video needs to be done about commercial real estate and all the intricacies around it. So stay tuned for that. I'll try to bring it out this week if I can. Stay tuned, hit the subscribe right down below, please. Look, Evergrande is one of those companies where I've been talking to you about this, saying the market wants to see stimulus. Look at that chart. After plunging, they reopened the stock. It was halted for like a year and a half. They reopened the stock up. It plunges down, and then here we go. It comes around for a surge. Of course, the markets love stimulus measures. Everything has been positive over the past couple days for China. And so that has really helped to push the stock up. I believe at one point it was up over 80% on that particular day. So watch that. Also lifting shares was commentary in China's state-owned Securities Times, which call for further easing of restrictions on the property market. So if they do get their way, of course, this is going to benefit them even more. I've been saying 100 times, the markets want stimulus. If they get stimulus, watch that baby go. We'll see. Okay. The indicator called the China Credit Impulse, which is something I've brought to you many times before, that was looking pretty weak, and that is a very good indication of what's going on inside of China, which then has a leading effect into the United States after a period of time. Last time I checked, it was pretty weak. So if they do and go for the stimulus, I'd be interested to see where we get this going. This is part of that, though. You got to understand real estate. So we've got it in China. We've got it inside of the U.S. with commercial real estate. But there's also this other factor, and that is WeWork. Just like people are pointing to the Airbnb, I was talking about WeWork as they were failing. There's just one issue about this. Look, a letter from WeWork CEO on the next phase of WeWork. Okay, interesting. What did he say? Well, it looks like kind of an issue. It's kind of a big issue. Here we go. In a financially sustainable manner, they're going to have to, figure out how to expand and do well. But as part of the negotiations, we expect to exit unfit and underperforming locations and to reinvest in our strongest assets as we continually improve our product. They are going to sell off all of their properties where nobody's coming in. And based on what I have seen, a lot of those properties, people are not using them. They're not profitable. And so that's going to be a big issue where suddenly the commercial real estate is flooded because they had a lot of real estate. WeWork had surprisingly a lot of real estate in some areas. So those areas are about to be flooded. The debt on those things they're going to be in big trouble. I'm going to follow these developments very closely. This is it. I want to see what you guessed after. We're going to look at it, but it is credit card delinquencies. That is really the big concern right now for many. And credit card delinquencies have risen. And when you were talking about introducing student loan repayments at this time, you know that this is probably going to get worse in the next 30 days. I will bring you updates as I can. There are issues going on in every category. And of course, we've got to watch this real close because these developments are going to affect you. But what can you do as an individual? Don't just sit there. Don't be idle. You got to take action. What are some things? Well, I took those down. Number one, you got to hold real assets. All right. Real estate in improving neighborhoods. You don't just go buy around the corner from where you are or where you think you heard is the best or where some guru told you. You've got to know that that is an improving market. You got to look for permits. How many cranes are going on? How much construction is happening? What is the vacancy rate? There are a lot of different things. Those are available on the Discord if you want to check them out. You got to pay attention to that data, the actual data, but also knowing that area is very important. Don't invest in what you know if what you know is not enough. You always hear that. Invest in what you know. Yeah, to a certain degree, but what if you don't really know something that's, profitable, beneficial? Like, what if that you got to learn new skills? That's the point. Learn new skills to get you to where you want to be. I learned e-commerce several years ago. That was a good idea. You don't have to learn e-commerce. You can learn something else. But the point is, You learn the new skills to get what you need. All right. Speculating is okay, but not with your whole portfolio. My goodness, how many people I see doing this. You can have a risk portion of your portfolio. That's okay. Take risk. That's fine. That's how you get to the next level, but not with your whole thing. I mean, oh no, it's fine. It's fine. This is $1 trillion company. Don't ever do that. Put that aside. Know what you're doing very clearly. If you want more details, you got to get on the Discord. Join me there. Comment of the day. Here it is, 147. This is Ship TJ01. Thank you very much for your comment. $147 per barrel before the Great Recession. We're talking about oil in this video. Thank you for talking about peak oil. I've been following the subject since I was first made aware of it in 2009. Peak oil. I noticed a lot of comments about this. People were asking themselves, or asking me, or asking each other, peak oil, what are you talking about here? This is not real. Or maybe it is. There's this big debate about it. But what I said and what I want to highlight here is that either way, they're pushing us off into this whole environment where we're not going to be able to do what we did before years ago. We're not going to have that freedom of choice. Things are changing rapidly, and that's why we need to be on the absolute edge of all this information. I hope you appreciated this video. If you did, I hope you'll check me out on Discord. Message me. Link is down in the description. I will get back to you. You can ask me any question and I'll be there. I'm going to be doing all kinds of stuff on there. Please stay tuned. It's a work in progress. See you soon.